afternoon, students. Today we discuss one of the important topics in the field of investment sources and methods of financing investment activities. In this lesson, we will discuss about the concept of investment financing, internal sources, external sources of the companies, methods of financing, selecting a financing strategy, and the summary conclusion of the lesson. So, let's begin discussing classification of funding sources. We can divide them into two types: internal source of financing, its own funds of companies, interpreters, and external source of financing. They are loans, credits, and etc. So, internal source of financing includes retained earnings, depreciation fund, reserve funds, asset monetization. Why internal sources are used first? Because they cost of no percent of capital. So, retained earnings. Retained earnings are net profit reinvested into the business after dividends. The most cost-effective internal source, indicating financial health of the enterprises. Depreciation fund. Systematic allocation for asset replacement provides steady capital flow independent of profitability cycles. Reserve funds. Accumulated reserves set aside for strategic investments includes contingency and development reserves. Asset monetization. Capital released through the sale of non-core assets, real estate or intellectual property rights. So there are examples of these financial sources. Retained earnings. A local coffee shop made a profit of 50,000 last year. Instead of giving all the profit to the owners, they reinvest $30,000 to buy a new espresso machine and expand into the space next door. Depreciation fund. Example: a taxi company sets aside $2,000 every month from its fares to gradually build a fund. After 5 years, they use that money to replace their old cars with new ones, avoiding the need for a bank loan. What about reserve funds? Reserve funds, a small software firm, saves a portion of its annual profits in a separate account labeled R&D reserve. When they want to develop a new app, they tap into this fund instead of seeking outside investors. And the fourth, asset monetization. A clothing retailer owns a warehouse that's no longer needed because they switched to online sales. They sell the building and use the cash to upgrade their website and marketing. So, external sources of financing. They can include bank loans, bond issues, insurance, equity financing, venture capital, government and grants, governmental financial resources and grants, and hybrid instruments. So, there are examples of, I'll give you examples of financial methods. Self-financing. A family-owned restaurant uses £50,000 from its own saving account to renovate the dining room. They take no loans and have no debt, but the renovation is limited to what they already have. So self-financing can be not large amount of funding resources. Debt financing. A manufacturing company needs $2 million for a new production line. It takes 1.5 billion bank loan and 5% interest and issues 100,000 in corporate bonds to institutional investors. This is combined financing, debt financing, and the leasing. An airline needs new aircraft but doesn't want to buy them outright. It leases planes from a leasing company, paying monthly fees to use them. Then, while the leasing company retains ownership. For students, can you give me an explanation of bank loans or your experience about bank loans? Alaya. Project finance. A consortium builds £1 billion of offshore wind farm. They create a special purpose vehicle, SPV, that borrows money based solely on the future cash flows from selling electricity of the project firms. If the project fails, lenders cannot go after the parent companies. Factoring. A textile manufacturer sells 20,000 pounds worth of goods to retailer and on 90-day terms to get cash immediately. It sells the invoice to a factoring company for 190,000, a fee of 5%. The factoring company then collects the full amount from the retailer later. So we'll go through methods of financing. First method of financing is self-financing. Complete reliance on own resources, maximum independence, but limited by available funds. The second one is debt financing. Leverage through loans and bonds amplifies returns but increases financial risk. The third one is leasing. Use of assets without ownership transfer preserves capital and improves cash flow. The fourth is project finance. Reinvest the SPV structure cash flows of the project service the debt independently. Factoring is sale of receivable to third parties, accelerates cash conversion from trade assets. And the last is crowdfunding. Aggregating small investment via online platforms suited for startups. A small bakery wants to open a second location. They go to a local bank and get a 100,000 term loan with 60% fixed interest rate to cover renovation and equipment costs. Second resource is bond issuance. In 2020, Apple issued 8.5 billion in corporate bonds to raise cash for share buybacks and dividends, taking advantage of low interest rates instead of using its own cash reserves. And the third, equity financing. When Facebook went public in 2012, it raised 16 billion through an IPO, initial public offering, by selling shares to institutional and retail investors. What about venture capital? In its early days, Uber raised over 11 billion from venture capital firms like Benchmark and Goldman Sachs to fuel its global expansion before going public. So, Sabi, can you give me an explanation of crowdfunding and your example from your experience?
Okay, firstly, what is crowdfunding? Crowdfunding is a way of raising money for a project or business, usually the aim of the project is usually social goals. Many people can contribute.
All of you know explanation of bank loans, so can you give me an example from your own experience about bank loans? Alaya, please.
For example, last year I borrowed from the bank to purchasing a laptop for my personal use, and this helped me greatly. The bank at 25% annually. So for 2 years I borrowed the amount of around 6 million sums to purchasing notebook.
Thank you. That's exactly